Welcome to the Monday show. I'm Will Woodall, Mike Rarey. Hey, Mike.
Hey, Will.
We're going to look at today's August 22nd. We're going to look back last week, talk about the markets last week, and then discuss our outlook and some interesting things that are happening in terms of where the bear market rally is or isn't, and where recession is trending or is not trending, and some new data we're going to throw at you at the end here. First, we're up the equity returns from last week. It's kind of a nothing week, but at least in the foreign space.
Yep. Not a whole lot going on. Positive returns for large caps, negative returns for small caps. A couple things to note is that the rally we've had here month to date has felt a little bit more defensive in nature if you look at the sectors that have done well. So things like utilities, consumer staples, and then energy rallying. And then the only really other notable thing on the U.S. equity side is the S&P 500 index, which had been below its 200-day moving average since April, finally came back up and touched the 200-day very briefly. Intraday, it was right around there, maybe even above it for a hot minute, and then lost momentum and sold back off towards the end of the week. And now we're trying to move above the 200-day moving average again, but failing to do so.
Yeah, last Friday was a big option expiration session, and the entire week was very low volume. Even on option X day, the volume was lower than normal for an option X day. So not a lot to say about the strength or weakness of this rally because the volume is very hard to predict. Let's look at the next slide. Fixed income for the week.
Yeah, and seeing some negative returns across most areas of the fixed income market. The U.S. Treasury yield curve shifting up just so slightly last week. Similar trends for month to date, seeing the Treasury yield curve shift up. A lot of that has really been because of the Fed speak that we highlighted during last week's shoot. Mm-hmm. So the Fed coming out and really throwing cold water on the idea of a Fed pivot and just reinforcing the fact that they want to make sure they do whatever it takes to defeat inflation. And so that Fed speak ramping up as we get to Jackson Hole Symposium this week.
Mm-hmm. Yeah, and maybe just for the viewers, fixed income markets and the yields on fixed income, especially treasuries, move quite a bit, and more so than I think people realize. Within a given year, you can have 50 to 100 basis points of movement in those yields. So this is not abnormal at all.
Right. We did also see, if you look into credit spreads, saw those widen out. So you see high yield bonds, emerging market bonds, underperforming higher quality areas of the fixed income market. And then no changes to our price or yield regimes across the board, all unchanged from last week.
All right, let's look at alts. REITs had a rough week.
Yeah, REITs having a rough week. Usually as longer term interest rates rise, they tend to sell off, and they're a bit equity sensitive. So, small caps last week were down. Most REITs are in that small mid cap range. So not a big surprise there given other market trends. Seeing commodities selling off just a little bit last week. But if you focus on the quarter to date time period, some interesting trends are starting to emerge. Really since mid-June, you've seen the entire energy complex come down, but you still see positive 15% returns for energy commodities since July 1st. So it's very interesting. Mm-hmm. WTI has come down, Brent crude has come down. Gasoline prices have come down from a national average, something like $5 a gallon to $4 a gallon. But energy commodities still up because of natural gas.
Yeah, I was gonna say, how much of that WTI coming down is a demand issue versus we're releasing more supply?
Yeah, it's definitely both. You definitely saw demand destruction as we got into June. Summer driving season, logging fewer miles than we otherwise would. And then also, yes, releasing oil from the Strategic Petroleum Reserve, some good news out of Saudi Arabia that they might increase production as well. So definitely a mixed bag.
Yeah. So that all that had an impact on inflation. You look at the path of inflation.
Mm-hmm. And so our forecast here, this is year-over-year headline CPI. You can see it out in the blue dashed area all the way to the right. And so this is our proprietary inflation forecast model, which takes the next 12 months of inflation and breaks it up into near-term forecast, medium term, which is sort of the middle portion of that 12 months, and then longer term. And reinforcing the idea of high and falling, if we were to throw consensus estimates on here, we're actually coming down not quite as fast as consensus, particularly as we get to the tail end of the forecast horizon. And our inflation model is definitely something we're excited to dig into in more detail in future video shoots and talk about, how we arrive at these numbers, the variables we use, all that.
But it's pretty interesting. So our forecast suggests it's going to come down and then probably level off for a bit, or maybe bump back up just a touch as we come into September, October, midterms, and then decelerate from there. What impact does that path have on the Fed versus just a straight move down?
It's going to be tough because they need to show progress, especially because the actions that the Fed has taken clearly is already having an impact on economic growth. So to see basically the negative side of their inflation fighting efforts, and then for the next couple months here, they're probably not going to see any additional progress on the inflation side of their efforts. That can be, that can be a time period that can be frustrating for the Fed, and you can hear a lot more hawkish rhetoric about needing to bring inflation down, willing to do whatever it takes to defeat inflation. So this is definitely going to be a frustrating couple months for the Fed.
We also saw home prices are starting to really meaningfully come down. How does that translate into the path here? Like, what has to happen to home prices in order for this sort of path to play out?
Yeah, so home prices aren't directly in CPI. So even if home prices were to start coming down, it wouldn't have a significant impact on the next 12 months of inflation data, because what's in CPI are rents, and rents follow home prices, but with a lag of about 12 to 18 months. So it's good news that home prices have stopped going up, because then, shelter can contribute less as we get outside of this forecast horizon, talking about late next year. But one reason why our forecast is slightly higher than consensus is because we haven't seen housing prices come down enough. We haven't seen recession probability come up enough. I mean, those are things that need to happen here near term to start to get this path of inflation to come down.
Okay, let's take a look at liquidity. We're still projecting a very steep decline in liquidity, and we're not even really starting yet, right?
Yeah, we're just sort of kicking into high gear now. We just moved into the low and falling liquidity regime, which is the worst regime for equities, particularly growth equities. And September is when the Fed increases the pace of their balance sheet runoff, or quantitative tightening, from a max of $47.5 billion a month to $95 billion a month. So we're really now just getting into the steep part of this liquidity decline. And then we show here in a forecast horizon the next 4 quarters, but we also forecast monthly outside of the next 12 months. And what's really interesting is if you go outside of the forecast horizon we're showing here, it's just money supply staying around 0 to 1% year over year growth for an extended period of time. So the duration, the amount of time we're likely to stay in this low and falling environment, that might be what ends up surprising people. We will have never seen a liquidity slowdown of this magnitude, so that's probably underappreciated in the market. But then once we get to the bottom, how long we stay there in order to bring inflation down could be surprising as well.
Right, yeah, because it is a monetary phenomenon.
Yep.
Okay, let's move on to net liquidity. We've shown this chart. I think we just introduced the chart a few videos ago, but let's detail it a little more here.
Yeah, so we talk about how low and falling liquidity is the worst environment for equities, so we want to show that more direct relationship. So what we have here is net liquidity in the US versus the S&P 500. And you see net liquidity, the green line, has really led the S&P 500 about a 2-week lead time since the pandemic started. So this goes back to April 2020. And what we're seeing here now is the biggest detachment of the S&P 500 from net liquidity that we've seen basically during this entire time period. And so this is a very interesting phenomenon. There are a number of factors under the hood here that we think are coming to an end. And that green line should start coming down again, which should act as sort of a force of gravity on the blue line, the S&P 500. So, digging into this, trying to keep it high level, but net liquidity essentially is Fed assets minus reverse repo minus the Treasury General account.
Right. And
you think about that as reverse repo is essentially organizations, companies, special purpose vehicles, et cetera, saying, I have too much liquidity. I need security. So I'll give you my cash, you give me security. So that's literally just excess liquidity that nobody needs. It's not in the banking system. It's not being used to create more loans. It's not being used to create any money at all.
Right.
It's kind of like useless liquidity. And then the Treasury General account is the same thing. The Treasury collects tax receipts and they pay out and they make government expenditures. And for a rainy day, or for example, if the debt ceiling doesn't get increased, they keep about $500 billion on account at the Fed. Once again, useless liquidity. It's not being put into the banking system. Banks can't use it to make more loans. So if you want net liquidity, this takes Fed assets minus those two useless liquidity numbers. And so that's sort of a true measure of the amount of liquidity that's in the banking system that can create more money. And so it makes sense that, if liquidity matters, then net liquidity should matter for asset prices, and that has been the case.
And this is a short time horizon that we've seen this correlation, but
yeah,
logically it makes sense when there's less money available to purchase securities or to be lent to purchase securities.
Yep. Then you sort of lose that last marginal buyer.
Lose that demand, right?
And all that's really happened here, this detachment, we've seen the green line go up because the Treasury General account has come down. So the government collected a lot of money in taxes in the springtime, way more than they expected.
Which they never talk about.
Right. So, and the TGA was up to about $1 trillion. So when they draw that down, the green line actually goes up. But they've already drawn it down to like 590 billion. So they're about done. They're about at the 500 billion. So that should be about over. Reverse repo is actually, that situation's gotten worse. So that number's gone up. And we know Fed assets are starting to come down. So as we sit here today, we think now that the TGA drawdown is about done, Fed assets are going to decrease at a much faster rate now. The Fed's increasing the pace of QT, quantitative tightening, and reverse repo hasn't really shown like it's budging at all. This green line is going to start coming down.
Yeah. Okay. Let's look at the impact globally, because we were just talking about the U.S. before. Now, globally, we are in the same sort of watching the same movie across the entire globe.
Yep. And when we talk about our framework,
China maybe.
Yeah, there are a couple outliers in here for sure. But when we talk about our framework and we show forecasts for U.S. economic growth, U.S. liquidity, U.S. inflation, the framework works globally. These things matter for just about every country in the world. So showing that liquidity matters on a global stage as well. If you take the aggregate money supply for all the G20 companies, translate that into US dollars, what you see is the same very difficult, scarce liquidity environment everywhere. We actually have negative year-over-year growth in US dollar liquidity. So, it seems crazy to think that there are actually fewer US dollars in existence today than there were a year ago. That's not exactly the case. It's the US dollar has gotten stronger, so foreign currencies are worth less. Nobody's destroying dollars. But this is just getting started. I mean, you think of all the other major central banks that are arguably in worse positions than the Fed in terms of fighting stubbornly high double-digit inflation in some cases, and still have to really start aggressively raising interest rates. I mean, Europe, UK, et cetera, the only real outliers here are Japan and China, which are somewhat neutral or stimulative in terms of their monetary policy. But because they're neutral or stimulative, their currencies are weakening dramatically versus the dollar. So it's still putting downward pressure on the blue line. And then we show the gray area, which is the performance of the MSCI All Country World Stock Index. showing, hey, liquidity is like gravity. If you have a liquidity suck, a liquidity vacuum, liquidity contraction, it's going to be a headwind for equities, and that's definitely been the case.
When you hit these points, you see these drawdowns, right?
Exactly, yep.
And
So
we're sitting on another one now. So,
yep.
All right, so let's move on to economic growth. Not much change here in the last week or so.
Right.
Still looking at a low and falling.
Mm-hmm. And all these central banks raising interest rates, the goal, the good part about that is you lower inflation. The bad part is economic growth will slow. I mean, central banks can only reduce prices by reducing demand. Demand in the economy is economic growth. So forecasts here in the light blue bars, they actually have come down again just over the past week. The year-over-year real GDP number in the US now, last week it was expected, consensus was 0.25%. Now it's 5 basis points. So just not seeing any signs of these blue bars coming up.
Mm-hmm. Can show that on the next GDP Now forecast.
Mm-hmm. And this, something we've shown previously from the Atlanta Fed, gives you sort of a real-time gauge on how the current quarter GDP print is progressing. The actual Q3 GDP print doesn't come out until the end of October. But it's important to look at the trends. So when Atlanta Fed made their first estimate of Q3 GDP with all the data they had as of the end of July, we were looking at 2.1%, and that's come down to 1.6%. And this far in advance of the real estimate, it can be off plus or minus 1.5%. So that's not why we're necessarily looking at this. It's just to look at the underlying trends. And really, if you focus on the orange, the residential investment, the housing market has been the area of the U.S. economy that since May has had the most persistent, most severe negative economic surprises. The data just keeps coming in worse than expected. Housing starts were miserable that were just released. The housing elements that contribute to GDP are new home construction. So when housing starts are weak, that's weak. Home renovations, and then realtor commissions. And all those things have pretty much grinded to a halt.
Yeah.
So.
And again, also just starting, I think.
Yeah.
We're just seeing the beginnings of these things. Yep. So let's move on, just touch on recession. Probabilities changed slightly from last week.
Yep. Yeah, not a material change. We wouldn't expect a material change. It was a pretty quiet week. Under the hood, if we look at the underlying indicators, there were some updates there that we want to speak to. So on the next chart, focusing on the top, percentage of the yield curve inverted continues to go up. And then we have two recession indicators that are based on the yield curve. So the New York Fed, the Cleveland Fed, those both continuing to move higher. So the yield curve is definitely starting to signal more and more bad things. And then you see the private housing starts down 8.1% year over year. So pretty miserable.
Yeah. And new chart we have just to show yield curve inversions. We got the 10-2 and the 10-3 month.
Mm-hmm. Yeah. So these are indirectly or directly in some cases in our recession model. So this is an opportunity to just look at these indicators specifically. And the 10-year versus the 2-year is the green line, and that's at negative 29 basis points. So that's the most inverted since the early 2000s. The 2-year is high because it's expecting the Fed to hike interest rates more. And the 10-year is lower because it's expecting economic growth to slow because the Fed is hiking short-term interest rates more. And so that's the second smartest economist in the room. You can see a 10s, 2s inversion, or when that green line goes negative, has preceded every economic recession since World War II, basically, with a pretty good lead time. And so, that's the reason why it's in our recession forecast. It's a great leading indicator on recessions. And then the smartest economist in the room is the 10-year minus the 3-month, which is the blue line, which is not yet inverted. It's a positive 0.32%, but the Fed is expected to hike interest rates about another 1% through the end of this year. So if the 10-year yield doesn't move and very short-term rates go up another 1%, well, that'll be inverted by about 68 basis points by the time we get to the end of the year. And that would also be the most significant inversion of the 10-year minus 3-month since the year 2000. So all these things these yield curve inversions are getting deeper, and they're starting to contribute more and more to our recession forecast.
And what, if any, impact does inflation being this high have on inversions?
Yeah. What you're going to see is shorter term rates have to move higher. So if the Fed's in September and they're looking at, core CPI and headline CPI year over year readings moving higher or moving sideways, well, then the market's going to expect that they're going to have to hike short-term rates even more in order to defeat inflation. And so the 2-year is going to go up higher, the 3-month is going to go up higher, and the 10-year probably at this point isn't going to move, or if anything, go lower, because all of those interest rate hikes mean bad thing for economic growth longer term, so the 10-year should snuff that out. So until the Fed stops hiking, we're still going to be living with yield curve inversions, most likely. It might even be until they start cutting that we're living with these yield curve inversions.
Which is a good point. Yeah, absolutely. Let's take some questions. We had people say September is the worst month for investing. Who are these people? What can you say about this, and how do you prepare? I think it's not the worst month. It's like there's a lot of volatility in September just because people are coming back from summer vacations. Volumes are definitely, people are positioning for the end of the year, and they're potentially starting to tax loss harvest, et cetera. But I don't know if it's the worst month.
Yeah. There's seasonality to U.S. equity prices because of all the things you just said. September, October are normally weak months. It also just so happens that some of the largest financial crises that we've had have occurred during Q4, late Q3. So, if you strip a couple of those out, September doesn't look as bad. So,
yeah, worst is relative, right? I mean, when there's opportunity, that could be good. So, all right, next question. Can you throw it up there? Is the bear market rally over? Nobody's asking this question. You get this question every day, actually. Nobody knows. It could be. Maybe it is. Maybe it's not.
I mean, everything we look at, if you look at how bear market rallies have evolved historically, it would suggest that 4,200, 4,250, 4,300 on the S&P 500 is about where the short squeeze should lose steam.
Right.
We've seen here recently the U.S. equity market is starting to lose a little bit of momentum, but
I mean, if you look at what was happening last week and the week before, just look at Bed Bath & Beyond as an example of what's going on in the market that really is not normal with that stock price and how that was squeezed up, and now it's back down below $10.
Yeah.
So
one other thing I would add on that is the rally is somewhat self-defeating in nature because of the Fed's current reaction function.
Yeah.
The Fed does, if they're trying to beat inflation long term, they do not want to see the equity market going up, and they do not want to see the type of blind risk taking and speculation like we saw with, for example, a Bed Bath & Beyond. So they would view that as, hey, we need to do more work to tighten financial conditions more to make sure these things stop so we can lower inflation. So it is self-defeating as long as this is the Fed's reaction function.
Yeah, I agree. All right, we have another one out there. So what is the unnecessary noise in the market this week? Well, I mean, the noise was Bed Bath & Beyond and the some of the meme stocks, right?
Yeah, that was definitely last week. And then this coming week, Fed Chair Jerome Powell makes this big speech from Jackson Hole Symposium. And so in terms of noise there, you could definitely have folks looking to buy protection before that, which could create some noise, dealer hedging, et cetera. So how investors start to prepare their portfolios for that event could create noise. And plus, we haven't seen much volume, so it's a lot of noise. There's very low signal.
Yeah, a lot of narratives out there. That's why we just stay focused on the data. When the data changes, we'll change. Everything we're doing in client portfolios is we're positioning for more defensively as the markets go up, and in preparation for potentially heading back down again. So if there's no other questions, we can wrap it up there. I don't know if we have any left in the queue. No? Well, thanks for joining this week, and we'll be back next week, the last week of August.